y'all just the basic information about these, but we looked at the entries and all on, which are not, those aren't that difficult, are they? Just to make your entries for purchasing your stock and all. So you can maybe view the. Why is it doing that to me? Okay, let's look at some more then. We'll just go ahead and try to get through some of this. Okay, estimating your corporate income tax and preparing your journal entries, and then the worksheet. Maybe we can get through this part. And then your adjusting and closing entries and your income statement, which is just the same procedure as we've been doing on worksheets. Difference is it's just figured a little differently. We're going to have to figure or make an estimate of our corporate income tax before we know what our income is, basically at the end. Okay. Disadvantage of the corporation, which you'll learn when you read those first part of your chapters in chapter 20, is that corporations have to pay income on their profits. And then, so it ends up sort of being double taxation in a way, unless you're an S corporation, which is something different. But because the corporation has to pay the income tax first, but then when the person gets the distribution of dividends, they have to also pay taxes. So in other words, that profit that the corporation's already paid the tax on goes to the stockholders, and they have to pay tax on it. What is that? Taxed here, taxed here. So that's one of the disadvantages. Remember, in your partnership, it only goes straight to the person, and they are only taxed on it. So difference being, of course, the corporate rates can be lower, and there are other advantages that offset that. But the rates are, and as of the printing of this book, first $50,000 that a corporation makes in profit, not net income, not sales or not total revenue, but profit. They pay 15%. The next 25. So it's sort of like you learned how to, figure the first 50, and you go to the next 25, 25%, and the next 25, 34%. So the more money they make, more taxes they have to pay. And if it makes over the $335,000 as of the printing of this book, they've got to go to the IRS and get publications for the rate. Sort of like your individual, right? When you get to a certain level, you got to go figure it on somewhere else, and not covered in the charts, right? Okay. Beginning of the year, we estimate our income tax expense for the coming year. It's kind of hard to do, right? We're going to have to estimate about what we think we're going to make. But we can base that on last year's income. You're going to have, because remember, we have to make those quarterly deposits. So we've got to make an estimate. We've got to make our quarterly deposits as we're estimating this tax. They're not going to let us go all year and wait till the end to pay the income tax, and then we say, well, we don't have any money, right? So we're going to have to send it in quarterly. So April 15th, June 15th, every quarter, September and December 15th, we have to make our estimated deposits of what we think our income tax is going to be. Then at the end of the year, we recompute it all and come up with an accurate figure. If it's more, we have to pay more, because it's sort of like what? Sort of like we do on income taxes, right? Same thing. If we've overestimated, they got to give it back, right? So, same thing. If you hadn't claimed enough deductions, what do you have to do at the end? You have to pay. Same thing. So that's all that is. Okay. At the beginning of the year, and here's your and what you would do is go ahead and claim it as income tax expense for your quarterly. So we've estimated it and come to that first quarter. We're saying, okay, we're thinking we're going to make $20,000 this year. I mean, our estimated tax liability at the end of the year is going to be 20. So first deposit we'd make, just divide by 4, make our first deposit, $5,000. Then on June 15th we'd make the next deposit. So this is just showing you you're making your deposit. happened? Well, we paid more than we had to, right? We overpaid tax, $400. So we make a adjustment. We go ahead and make it to our, we debit the income tax expense and credit income tax. If the quarterly deposits were less than what we should have paid, we'd have to add more to our expense account and credit income tax payable on that last, at the end of the year. But if it was more, if we paid more in, then we're going to get a refund, right? Income tax refund.
But they're technically not going to get a refund. What they do is just tie it over.
They would pay less, right? At the end, they would make that adjustment. Well, actually, no, they would get a refund. If they had already paid it all in, yeah, they would get that back. Or at least get the credit for it, but we're going to show, they would show it as, it's got to come out of that expense account and show that we're going to get money back. Or, like you said, yeah, credit on our next tax. When we fit in the next one. Okay, let's see. 2 ways to show the expense on the income statement: as a deduction at the bottom, or as an operating expense that's included in our operating expenses. Income reported on your financial statements will not usually match your taxable income reported on the income tax return because they have different rules. And so, remember some of the things we had covered in the tax laws, on the taxes showing, well, like when y'all figured something, we had to use the income tax method versus the other method, and on trade-ins, on things like that. So the books and the tax reports may not match. So you got to have 2 sets of reports. Okay. All right. Because in tax work, sometimes incomes, since it's not collected or whatever, can be put in different years. Anyway, I'm going to let y'all read all this kind of stuff. Okay. Let's look at the worksheet. Looking at the worksheet, how is it different? No different. They're almost exactly alike as you did for your sole proprietorships. Same columns, generally the same type entries. Except you got to show that income tax adjustment first, and you may not. And it's really before you're going to have to adjust it, because you're going to have to adjust it to show, because right now at the end of the year you're doing your worksheet, you're finding out how much you made actually. So that's where you're going to have to go in there and adjust that income, whether you have put in too much or not enough. That's where the adjustments are made. Alright, so let's look at it. Okay, so in the income statement columns, before the adjustment, you total your income statement columns before you make your adjustment for your income tax. So you're going to figure up your income statement columns, debit column and credit column, and you're going to leave it. It's going to be the income tax expense is going to be left blank. We're going to go ahead and figure out the net income before tax. Okay, so we'll come up with a net income before the tax is taken out. This is the tricky part of it. This is the one thing that will be tricky. This is the one thing that can be tricky. Okay. Because you have to figure it without knowing what your net income is. And then actually, when you figure it, net income before the tax expense is taken out is not really your net income, because you got your net income is after your tax expense is taken out. Okay. So,
kind of only halfway done at that point.
well, you're sitting here wondering, well, what in the world? Okay, so now I've got to figure it. So let's see what we do. And I've done this. You go ahead and compute your income tax expense based on, okay, what we decided was we had $110,000 net income before tax. So what do we have to pay on that $110,000? Well, the first $50,000 is at 15%, right? Here's part of our tax expense. figured it, right? Took that number, figured it. 26,150. Okay. Then we're going to go back and look and see, okay. How much we put in. Is this talking about the same company? That doesn't make sense to me.
He's talking the same company.
So he actually had 110,000 and he thought he was going to, well, no, he was pretty close, wasn't he? Because it was 26.
Yeah, and it's 20.
And when they ended up with 20,000, okay, they had deposited 20, but we were due 26, whatever. Okay. Oh, there it is. Just wait. Wait on that one. Okay. So we got to pay an extra $6,150. So that's ours. We've got to send that in to them, right, on our income tax return. And we record this adjustment that we just discovered in the adjustments section of our worksheet. So in our adjustments column, we will have a income tax adjustment for that 6,000. So we would debit the income tax expense and credit the income tax payable for $6,150, showing that we got to pay this much more and it's due. And then that's going to be filled in after you've done these calculations. Go back to your worksheet and fill in those two places. That's one of your adjustments. But notice you have to do that adjustment after you've completed all your other columns and carried them across and figured your net income, right? Okay. So, you see what I'm talking about? It's kind of a backwards situation. Okay.
Move ahead and then move back.
Move back. You got to go ahead and do it, but just don't complete everything yet. Just leave it and then go back to your adjustments column and make that adjustment. So that's the trick. Okay. Whoa. And what do? We always make our adjustments, You're going to have adjustments to make on different things, just like you did for the partnerships and for the sole proprietorship, supplies and insurance and all that. The same kind of adjustment, only this one would be included in it. Your income tax expense. Then closing, we close the revenue again. Still using that handy dandy income summary, right? Close it to the income summary. What's next? Expenses, same procedure. Look and see if we have a net income or loss in our income summary. Close it to, instead of capital though, it gets closed directly to retained earnings. So you don't have to worry about separating it up for partners, or it just goes straight into retained earnings. So it's not that bad, right? And when we close it out to retained earnings. Any other kind of items that we have to deal with, highly unusual, and those are things like we talked about a little bit in the partnership one. If you have a loss on the sale of an item or anything extraordinary loss, you had a tornado and it tore up everything that would go under your extraordinary losses at the bottom. After you've done your corporate income statement, after you've shown regular operations, right? Then if you have anything extraordinary, either you had a windfall, you sold something and made a lot of money on it, or a piece of land or a piece of equipment, or anything that happens or a loss occurs, that would go at the bottom. It's like we did have one for other income and revenue. Now you'll have one, I believe we'll even call it extraordinary losses and gains. Just another section at the bottom of that. Make sense? It's just something different. You just figure it somewhere else. Okay, let's see if we can get through this. This is on paying the dividends, which we will have some entries on paying the dividends, declaring the dividend, payment of cash dividends. And sometimes they pay the dividends, they issue people shares of stock as their dividend. And sometimes, have you ever heard of this? They split the stock. The person, instead of having 10 shares at $100, they now have 20 shares at $50. Very, very good when that happens, right? Because then it starts building back up, usually to the $100 level in the regular market. And recording any appropriations of our retained earnings, which would be like for stock preferred dividend payment. business, it's not a cash fund, it is then allocated or reinvested usually in the same business, has more inventory, right? Buying plant and equipment, we allocate we have so many retained earnings for that, various types of other assets, and it may be distributed to our stockholders, which we hope after we set up our budget for next year and say, we're going to need this, this, and this. This is how every business operates. This is how this school operates. We set up our budget first. What are we going to need? Then, after we find out and allocate that, I'm going to say we're going to have to keep this amount in retained earnings to do these things we've got to do next year. Or it may be distributed in the form of dividends to your stockholders. And these appear down in the stockholders' equity section of your balance sheet. So it's going to show, retained earnings is going to show anything that those retained earnings are being allocated for or held for. When you do have a dividend, the declaration date is the date when your board of directors has agreed upon it. The date of record is the date that you're going to actually give it. So they declare it on a certain date, and in that declaration, they set up the date that they're going to actually pay it. And then the actual payment date is the day on which you just go ahead and show your entry of paying it. All right. When we declare we're going to do a dividend. Down there in our retained earnings section, we're going to take it out of retained earnings, and we're going to put it in a common or preferred account called dividends payable. Oh, okay. It's not a warning or something, is it? So on the declaration date, that's what we do. On the record date, we just, over here, we're going to make a list of who all's going to get it. It has nothing to do with an entry. It's a place where we're keeping up over here with who gets stock in our big book of stockholders. And we're going to show who's getting it, who's getting the dividend, and how much they own, and how much their dividend's going to be. On the payment date, we're going to do it just like we do any payable account. We're going to debit the payable and credit cash. And the money goes out to the people. Just like if it was a salary payable, only it's a dividend. Okay. Stock dividend is when they issue more stock. Maybe made on a pro rata, how much you own. You get if you own 10% of the company's stock, you'll get 10% of the amount we're allocating in stock. It involves an account called Common Stock Dividend Distributable. It's an equity account, and it's used to record shares that are going to be issued as a result of a stock dividend declaration. In other words, we're sending them out in stock. If we give it to them and we're giving them a value that's over the par value, stock they're getting is over par value, we've got a paid-in capital in excess of par that we're going to use, just like before. So we declare it. When we declare it, same thing for all declarations. It comes out of retained earnings and it goes into whatever we declared to pay, which in this case would be common stock dividends distributable. Okay. So whatever we take out of retained earnings, and whatever reason we're taking it out, we put it in that special account to show what those retained earnings are allocated for. This is just going to take us doing it, I know, and you're going to do that for the value, the par value, and then if we distributed stock that was worth more, then the rest of it goes in the paid-in capital in excess of par. Okay. And then on distribution, we debit the distributable one and credit common stock. In other words, it goes from what we were going to distribute into the common stock, showing that those were distributed in our common stock account. All right. I know you're not going to remember all this, but you're going to need to just look it up as you go, basically. But I just want you to have a general understanding. The book value, again, is whatever stock it is, the total equity divided by the number of shares gives you the book value of each share. You just divide the number of shares that have been issued into what you're showing as your equity amount for those shares, and you can get how much they're worth. Okay. If you have a stock dividend, the book value stays the same just in a stock distribution simply because you just got more stock and more value distributed. That's not going to make a difference on that. Book value per share, you take your amount of equity for that share and the number of shares, and you just divide it. If you have a stock split, that means we're going to stocks difficult to sell. Apple stock right now is at $600 a share. One time it was $5. How many shares do you think they can sell right now at $600? Who's going to buy those shares? Not me. So they're wanting to get more activity going on in the market. They'll do a split. That lowers the cost per share, right, and people can afford it. Let's say Walmart got up to, I know this has happened a bunch of times with Walmart stock. It gets up to about $60-something a share, and they'll do a split, bring it down to like $30 or $25, and then people, if they want activity, then people can afford it. Okay, and get more activity in the marketplace. Okay, so they would do doesn't change anything in the capital accounts. It just requires a memorandum and says, on this date we declared a 3-for-1 stock split, reduce the stated value of the common stock from $75 to $25 a share. They've really cut it on down there, haven't they? And what they do then is showing instead of the 40,000 outstanding, now they have 120,000 shares outstanding. But it has to still be part of that amount of shares they have authorized from the beginning. You can't just add more shares. They have to have 120,000 shares as authorized by the board in order to do it. Okay? Appropriation is that's what we're setting it up. What are we going to do with it? We'll restrict some of it to dividend payments if we have preferred stock. If we have preferred stock for stock that we know we have to, we're not just going to say, here's all the retained earnings, go give it to the people, because we've got to have money to reinvest, to fix our equipment, because if they distribute it, it takes all their cash out. What have they got? No cash. How are we going to do business?